The inflation reading came in at 8.3%. The stock market's down. Here's what investors need to know about the inflation report and what I'm doing with my portfolio in response to the numbers. Let's get into it. All right, we see the headline, inflation barreled ahead at 8.3% in April from a year ago, remaining near 40-year highs. That sounds horrible. Everybody's scared. The stock market's down, the Dow's down 0.38%, S&P 500 is down 0.75%, and the Nasdaq's down almost 2%. Consumer Price Index accelerated 8.3% in April, more than the 8.1% estimate and near the highest level in more than 40 years. Here's what I'm really paying attention to. The CPI increased 8.3%, which was, it was higher than the 8.1% estimates, but it was a slight easing from March's peak and was still close to the highest number since 1982. So a couple things there. That ease from the peak, I think we have hit peak inflation. And so those numbers are slowly going to come down, in my opinion. And we're at the highest number since 1982 because of the numbers that we're coming out of COVID and trying to get the economy reopened and with all the stimulus and everything. So I still don't think that this inflation is going to persist. This is what people are most likely afraid of and why the markets are reacting the way that they are. The Federal Reserve officials have responded to the problem with 2 interest rate hikes so far this year, and they pledge more until inflation comes down to the central bank's 2% goal. As you know, if you follow my channel, I'm building a portfolio that's designed to grow from $10,000 to $1 million over the next 10 years with adding money along the way every 2 weeks. I'm sharing everything transparently right here, so if you like that kind of thing, like this video, subscribe to the channel so you never miss an update. The portfolio is currently valued at $39,000, down about $1,800 today, which is down about 5%. Terrible day. And then all in all, we've put in $53,000, so we're down about $14,000. This says down 67%. If you do the math, 14,000 divided by 53,000, which is what we put in, we're really down about 26%. And I think I would need a 36 to 38% gain from here to make that $14,000 up and get back to even. So the question is, what am I doing with my portfolio in response to these inflation numbers? I'm not doing anything. And in fact, I have a plan. I'm a long-term investor. I save part of my monthly income every month, which is what I think is a realistic option for people to do, not try to time buys and sells based on what they think the market is going to do and what the inflation read is going to be. Even if I know what the inflation readout or earnings of a company are going to be ahead of time, half the time or more than half the time, I still couldn't tell you what way the stock's going to go or the stock market is going to go if I knew the outcome ahead of time. So that's why I don't mess with trying to time and guess and gamble on what I'm going to do over the next day or the next week based on what I think earnings are going to be for a single stock or what I think the inflation read is going to do. What I'm trying to do is buy into companies that I want to hold for 3+ years in great businesses that are at decent valuations, maybe a little overpriced. I'm okay with that. Not extreme valuations. That's what I'm trying to avoid because I think that's the best way that normal people can do well in the stock market. And if you're not interested or don't have the time or the temperament to invest in individual stocks, then index funds are perfectly appropriate in an almost guaranteed way. If you look at the history of the stock market, just owning the S&P 500 over periods of 20 and 30 years and contributing a growing percentage of your paycheck when you can, it is almost a guaranteed way to become a millionaire if your time horizon is long enough and you're able to contribute enough money over time. And I can make a whole video on that and what that calculation looks like. If you want to, just let me know in the comments. And here's the companies I own and the day that we're having. It's a pretty crappy day, but that's all right. Snowflake is the largest position, about $4,400. GitLab around $4,100. Tesla around $4,100. Datadog around $4,000. Cloudflare around $3,000. MongoDB around $3,000. CrowdStrike around $3,000. And you can see the rest here. The trade desk is a bigger position now than it was yesterday. I just bought about $1,000 of the trade desk today. I'm going to do a video on that later, so make sure you subscribe to the channel. But you can check out my email newsletter, austin.substack.com. It's linked in the description below, where I went into a deeper thesis on why I added the trade desk today when I did. And if you want to see the rest of the portfolio, here it is. You can take a screenshot and do whatever you want. You know, the stock market is down. The S&P 500 is down about 15% from all-time highs. And there's a lot of people out there saying, doomsday headlines and saying could have avoided it if you would have avoided being investing when the Fed was raising rates. The truth is, I mean, and it looks obvious in hindsight now, nobody knows ahead of time exactly what the Fed is going to do. And then nobody knows if that's been baked into the market or not ahead of time based off people thinking or guessing what the Fed is going to do. But what we can do is we can try to be careful about not getting too overexcited when times are good or too scared when times are bad. And the way that we can work on doing that is using things like the price to earnings ratio for the S&P 500 or a lot of dividend and profitable companies. You can look at their multiples using price to earnings ratio, or with the growth companies, a lot of companies that I own that are not yet profitable, find ones that you think have a logical path to profitability and are showing that, and then we kind of value them on a price to sales basis. So this is a look at the S&P 500 using fast graphs. And, you know, this has been a time of interest rate hikes, yes, and inflation and the war in Ukraine, which are all reasons that, you know, have probably driven the market lower. But the fact of the matter is there was a lot of excitement through 2019 and 20. Well, really 2020 when we started getting the stimulus and the easy money policy after COVID, all the way through the end of 2021. And if we look here, this tells us that the average price to earnings ratio, this blue line for the S&P 500 since 2001 has been about 18. And you can see every time the stock is around that blue line, you know, returns are usually okay for pretty extended periods of time. At times where it's gotten way above the average, that's when we've seen pullbacks in the S&P 500, either due to a big event or maybe interest rates rising a little bit, or really just things coming back in line in general with reversion to the mean and what the averages are. And if we look at it, that's what happened at the end of 2021. The S&P 500 got up to a price to earnings ratio of around 23, which is very high. I mean, that's, you know, roughly 20% above its average. And guess what? The S&P 500 has now dropped about 15%. So I don't know what's going to happen, but if I had to guess, we might be in for another 5 to 10% drop in the S&P 500. Those things happen, but I'm not out of the market trying to wait for that and time it, because I don't know if it's going to get worse than that. I don't know if it's going to get better. What I'm doing is I'm investing money that my family doesn't need for the next 3+ years and plan to keep that money invested for a long time. That's my defense to the market moving up and down. I'll show one quick example. Again, I talked about this. I wrote about Trade Desk this morning in my email newsletter, austin.substack.com. But I'll show an example of the Trade Desk. The Trade Desk is down from about 107 per share down to 43. That's like a 60% drop. Well, in my opinion, the Trade Desk didn't become a worse company. The world's not ending, although, you know, companies are thinking about cutting back on spending. All that stuff's normal. That's business cycles. What happened was the valuation, the multiple got way out of line. The price to sales multiple on the Trade Desk was 46 in November of 2021. Its average price sales ratio, even with that included, since 2016 is 18. So if we're using tools like this and we know that the average was 18, and actually before all that craziness, it was actually less than 18, because that craziness, you know, skewed the average. So even through 2020, the normalized price sales ratio was 12. And my guess is 10 to 12 is a decent price sales ratio for the Trade Desk to be at kind of long term. So anyways, when we see it get up to 45, 46, we've got to be thinking the days are numbered here that these price sales ratios are gonna stay where they're at, and we're due for some kind of pullback. And so now here we are, we're down to 16. And is that a little high? Yes, I think it is. But when we think about forecasting, and this is why I try to be a long-term investor, and you know what analysts are kind of expecting the stock to do over time, these will be wrong, but they're decent enough guesses. And we bring this out to say a price sales ratio of 11 in 2024, we're looking at an 11% annualized return from yesterday's prices. That's good enough to me, a reasonable enough valuation to think about buying a stock and building it over time if the company continues to be great, for me to own it and for me to not be, not be scared to own it because we might drop a little bit from here. At that point, I think the risk or reward continues to get better if the stock price goes down and the company stays great. Again, this is just my thoughts and what I'm doing. I truly have no idea what's going to happen over the next 3 weeks, 6 months, or even year. But I think I own some great companies for the long term. So again, if you like that kind of thing, like the video, subscribe to the channel, and I'll actually be putting out a video with my review of the trade desk on this channel. So check that one out.